Hey guys, welcome back to Diamond Nest Egg, where we live and breathe personal finance every day. Today, we're going to talk about retirement accounts. 401k, IRA, Roth, traditional. What do all these different terms even mean? And how do you figure out which retirement account to go with? Well, stay until the end of this video and you'll be able to figure out how to decide between the different retirement accounts that might be available to you. I'd also like to take this opportunity to thank all of you that have supported us on our financial journey to bring personal finance to as many people as possible. We started this channel only a few weeks ago and now have over 50 subscribers and are topping 1,000 views. So thank you to all of you that have helped us kick off our financial journey on YouTube. For you and your support, we will be forever grateful. For those of you new to Diamond Nest Egg, I'm Jennifer, money coach, personal finance guru, and student loan expert to Gen Zers and young millennials. And we're here every Sunday with a new video about your money, covering everything from saving and investing to insurance and retirement. So if those are the things you want to learn about, hit the subscribe button, turn on the bell, and jumpstart your debt-free, financially free journey with us. Let's start first with a 401k. Do you have a 401k or an IRA? Or perhaps you have a Roth or a traditional IRA? Pop in a comment below. We'd love to hear about your retirement journey. So very simply stated, a 401k is a company or employer-sponsored plan that helps you save for retirement. 401ks are tax advantage, meaning both you and your employer get certain tax benefits if you take part in this retirement plan. Sometimes you'll also hear people mention a 403b or 457 retirement plan. We'll talk briefly about those as well. But know that 401ks are offered to employees at private for-profit companies like Microsoft, Citibank, or Disney. And 403bs are offered to employees at private non-for-profits, as well as government workers, such as public school employees. And 457s are for folks that work for state and local governments and some nonprofits. Now, all these numbers, 401k, 403b, and 457, may sound complicated, but in reality, what they represent are sections in the Internal Revenue Tax Code where you will find more info on these plans. So for example, if you go to section 401k of the Internal Revenue Tax Code, as you can see here, you'll find details on employee benefit plans offered by private for-profit companies. Again, like Microsoft, Google, Disney, Facebook. So don't let all these numbers confuse you. To make things a bit less of a mouthful, when I refer to a company 401k retirement plan in this video, keep in mind that this also applies to 403bs and most 457 plans. One of the great things about 401ks is that your employer will sometimes match part of the money that you contribute into your account, what is often referred to as the company retirement match. Your employer doesn't have to offer a company retirement match, but if they do, take advantage of this. In fact, in our signature course, Master Your Money Moves, maxing out your company retirement match is step 2 because it's free money. And who doesn't like free? Our 7-step Master Your Money Moves course is the Personal Finance 101 course that will walk you through how to save more each month, pay off debt, and start building your nest egg. The course will reopen again in a few months, so if you're interested in joining our waitlist, sign up via the link below this video and you'll be the first to know when registration opens up again. So how much free money could you get by maxing out your company retirement match? Let's just assume your annual salary is $60,000, which is about the average in the US, and that your company matches you $1 for every $1 that you put in to your 401k, up to 3% of your salary. You would get $1,800 of free money every year from your company, so long as you also contributed $1,800 into your 401k. And now let's take this one step further. If you and your company did this for 30 years, So you put in $1,800 every year and your company puts in $1,800 every year. And for the sake of easy calculation, we're just going to assume that your salary stays the same at $60,000. It doesn't change over time. Just your company's contributions alone would grow to nearly $180,000. 180 grand of free money from your employer over 30 years. That's not bad, right? And so for this calculation, we used our standard inflation adjusted average market return of 7% and the compound interest rate calculator from investor.gov. So you can go over there and put in your own numbers and check out what these numbers could look like for yourself. As I mentioned, maxing out your company retirement match is step 2 in our 7 Master Your Money Moves course. So if you're not doing it already, pause the video, do it, and then come back and continue watching. It might be as simple as logging onto your company retirement site or emailing your HR department. Seriously though, if you're enjoying this video, give us some love, hit the like button, and subscribe. It really helps move this video up the YouTube charts and allows us to bring our financial education efforts to the rest of the personal finance community here. The other great thing about contributing to your company 401k is that everything has already been set up by your company. Once you let them know you want to open an account and how much you want to contribute each month, the money will automatically be deducted from your paycheck and put into your 401k. You kind of set it and forget it. There's no paperwork, no transfers, no feeling poor at the end of each pay cycle because you never even see it in your bank account. Now, if you're watching this and thinking, man, I'm feeling pretty poor already, how am I going to come up with some extra cash each month to save for retirement? Go to the freebie section on our website. I've included the link below this video and download our budgeting template. It's super easy to use. Just fill it out with your income and expenses. See where you're at, where your money leaks are, and figure out how you can dig up some extra cash every month. And for some more financially free inspiration, you can also check out our playlist here on how to start saving smarter. Something also good to know is that the maximum allowable amount that you can contribute to your company 401k in 2021 will be $19,500, with total maximum contributions, meaning your own contribution plus your employer's contribution, to not exceed $58,000. And if you're over 50 years old, you're allowed to contribute additional amounts in order to catch up. I've included the IRS link below if you want more details on any of these numbers. All right. So far, we've covered company retirement accounts like the 401ks, 403bs, and 457s. Now, let's move on to personal retirement accounts like the IRA. We'll also talk about the difference between a Roth and a traditional retirement account. IRA is just short for individual retirement account. And an IRA is exactly that, a personal, individual retirement account that you open yourself and that you fund or contribute to yourself. Your company has absolutely nothing to do with these personal IRAs, and there is no company retirement match or free money to be had here, unfortunately. Now, you can open an IRA up with Fidelity, Vanguard, Betterment, and any one of those similar firms. If you want to learn how to open up your own personal IRA and where most of our clients go to do this, then definitely hit the subscribe button because we're going to have another video on this in the coming weeks. In terms of deciding between a 401k and an IRA, what some of our clients do is max out the company retirement match on their 401k. And once they've done that, then they contribute the maximum allowable amount to their personal IRA. And then they go back to putting money in their company 401k. The reason for this back and forth between company 401k and personal IRA is because once you've maxed out your company retirement match, the free money from your employer is gone. There isn't that incentive to keep putting money in there. And by putting money in your personal IRA, you're able to invest in a greater variety of investments. The investment options in a company 401k are usually limited to a handful of target date funds and other types of funds that are pre-selected for you. If you wanted to buy shares in Zoom or Apple, you wouldn't be able to do that via your company 401k. You would, however, be able to do this in your personal IRA. So in a nutshell, the reason to start putting money into your personal IRA after you've maxed out your company 401k, after you've taken that free money from your employer, is because you can invest in individual stocks, funds, and other stuff that might interest you. If you kept all your money in your company 401k plan, you would always be limited to the 10 or 20 plus funds that they have pre-chosen for you. Having said that, we also have clients that just want to keep their financial lives minimalistic. They don't care to invest in individual stocks. They are perfectly happy with the investment options that their company 401k plan offers. And those of you that know or work with us know that we advocate simplicity when it comes to your finances, whenever possible. Listen, life is chaotic enough. Why add complexity if you don't have to? To learn more about how to simplify your finances and good versus bad money habits, check out our money mindset and behavior playlist right here. So if you're a person that wants to keep things as easy and uncomplicated as possible, you can do what our clients like yourself do. Just continue to invest in your company 401k plan, even after you've maxed out your company retirement match. And when you reach the maximum allowable contribution for the year, and you still want to put more money towards retirement, then start contributing to your personal IRA. So far, we've talked about who sponsors and funds an account. A 401k is sponsored by your company, and in the best case, is funded by both your employer, through the company retirement match, and by you through the reduction in your paycheck. An IRA is personal and funded by you only. So now let's talk about how these accounts are taxed, which is where the Roth and traditional retirement account comes in. Remember, retirement accounts are tax advantage, meaning they offer certain tax benefits. That's why most folks don't just simply leave their retirement savings in a regular brokerage account, because then they wouldn't be able to reap the tax advantages that retirement accounts offer. For this video, we'll focus on Roth and traditional IRAs and how the taxing is different because they've been around longer. Some companies have also started offering Roth 401ks in recent years, but we'll cover that in a future video because the Roth 401k is still fairly new and comes with its own particular set of nuances. So a Roth versus a traditional IRA. In both instances, your money grows tax-free while it stays in the account. The biggest difference between the Roth versus the traditional IRA is how and when you get your tax break. On the most basic level, with a Roth, you pay taxes on the money you put in now, but you don't have to pay taxes when you take your money out later. And with a traditional, it's the exact opposite. You don't pay taxes on the money you put in now, but you do pay taxes when you take it out later. Which means the big question you have to ask yourself when deciding between a Roth versus a traditional IRA is, do you think your tax rate will be higher or lower in the future than it is now? All things being equal, if you expect to be in a higher tax bracket in retirement, then you should choose a Roth IRA because you'll be paying less taxes now. This is particularly true for our younger clients and those that are recent grads just kicking off their career, because the assumption is that their income will grow with age and so will their taxes. So better to pay taxes now when they're lower. On the other hand, if you expect to be in a lower tax bracket in retirement, then you should go with the traditional IRA because you'll be paying less taxes later than you would be doing now. The first thing you should do is to check if you even qualify for a Roth IRA based on your income level. In 2021, if your modified adjusted gross income will be $140,000 or more as a single filer or $208,000 or more as joint filers, you can't even contribute at all to a Roth IRA. So the decision becomes pretty simple here. You go for a traditional IRA, which has no income limits. If, on the other hand, your modified adjusted gross income will be less than $140,000 as a single tax filer or $208,000 as a joint filer, you can contribute to a Roth IRA. Just know that the amount that you can contribute to your Roth will be reduced the closer you get to those Roth income limits. I've included links below if you want more details on modified adjusted gross income and Roth IRA income limits for 2021. So assuming that you do qualify for a Roth IRA, the maximum amount you can put into it in 2021 will be $6,000 if you're under 50. This $6,000 limit includes all your IRAs. So if you have both a Roth and a traditional IRA, which you can, the total contributions across both your Roth and traditional IRAs cannot be more than $6,000. And if you're age 50 or over, the IRA contribution limit is $1,000 more at $7,000 so that you can catch up. And yes, you can have both a Roth and a traditional IRA as well as a company 401k. A brief note here as well, for your traditional IRA contribution, the deduction you can take from your taxes is also reduced as your income increases. And again, the details are also in the description below. If you're eligible for a Roth IRA, here's 3 reasons why you may want to go with a Roth versus a traditional IRA. Reason number 1, the Roth IRA is simply more lenient when it comes to pre-retirement withdrawals. You can withdraw your contributions, that's the money you originally put into the account, at any time without having to pay income taxes or early withdrawal penalties. Now, the government's not trying to be nice here. You already paid taxes on the money you originally put into your Roth IRA, remember? So whatever amount you put in, you can take out without paying taxes or penalties on. However, say that you contribute $10,000 into your Roth IRA and your money has grown to a significant amount over the years. If you withdraw $11,000 before you turn 59 and a half, the original $10,000 contribution would be tax-free since you've already paid taxes on that amount already. But you would still have to pay income taxes and a 10% withdrawal penalty on that extra $1,000 because it's considered earnings or capital gains. With a traditional IRA, you would have to pay both income taxes and a 10% withdrawal penalty on any and all amounts you withdraw before the age of 59 and a half because you didn't pay taxes on your original contributions, unlike with the Roth IRA. So you got to pay them sometime. There are some specific instances when you may not be charged the 10% early withdrawal penalty, such as when you purchase your first home. Reason number 2 for possibly choosing a Roth over a traditional IRA is that with a Roth, you don't have to start taking money out of your account at age 72. With a traditional IRA, you have to start taking required minimum distributions at age 72. With a Roth IRA, unless you're inheriting it, there are no rules for required minimum distributions. You can keep your savings in there and let them grow tax-free for as long as you live. Reason number 3 for potentially going with a Roth versus a traditional IRA is that what you see is what you get. This goes back to the concept of keeping your financial life simple. With a Roth, you don't have to worry about what your financial circumstances will be in 10, 20, or 40 years, or what your tax bracket will be. When you see your balance, that's it. What you see on the screen or on that piece of paper, it's all yours. That's what you get. And there's a lot to be said for certainty, stability, and peace of mind when it comes to your finances. So to sum things up, these are the client strategies that have worked best. First, contribute enough into your company 401k to max out your company retirement match. Once you've maxed out your company retirement match, if you want to invest in individual stocks or diversify your investments outside of your company 401k, start contributing to a personal IRA. And after you've maxed that out, then go back to contributing to your company 401k. If you want to keep your financial life simple or have no interest or desire in researching and buying individual stocks and other investments, continue to contribute to your 401k even after you've maxed out your company retirement match. And only open a personal IRA when you reach your 401k limit and can no longer contribute to that anymore. We hope you enjoyed this retirement video and found it educational. Ultimately, what you decide to do will depend on a few factors, such as how much money you have to put towards retirement, what you think your financial and tax circumstances are going to be now and in the future, and a number of other things. We know that everyone's financial journey is different. So if you want to chat further about your specific situation, shoot us an email at hello@diamondnestegg.com. Thanks for watching. If you like this content and want to see more like it, give this video a thumbs up and hit the subscribe button. We really appreciate you supporting our channel growth, and we'll be back next Sunday with more great money goodies. In the meantime, check out some of our other videos on this channel.